Hello friends, I am Dr. Pragnesa. So this is my second lecture on the stock market investment. So here the topic is what to buy. So we will discuss small cap stocks and stocks which are out of radar of the Wall Street. Peter Lynch says big companies have small moves and small companies have big moves. So this is the graph of Magellan Fund that was managed by Peter Lynch. It had given around 29.1% CAGR return in just 13 years of duration. Peter Lynch is also called as master of small cap stocks investor. So Babu George Valavi from Kochi was distributor in small company named Mewar Oil and General Mills from 1970 to 1980. He also bought shares of the company during that period. He had literally forgotten about the investment. It was only in 2015 his son discovered the share certificates and found that the company's name has been changed to PI Industries and its investment value was around 1400 crore rupees. So this is the power of small cap stocks invested for long term. Many people have made fortune from the small caps and lots of people have made huge losses from the small caps. So what to buy? There are 13 various checkpoints that we have to study before buying the stocks. We will discuss just small caps and stocks which are out of radar, that first 2 points. Now we have various queries and I will try to solve these queries in my lecture. Why small cap stocks give superior return than the large caps? What are the risks of small caps and how to reduce the risk? Why most retail investors and even institutional investors stay away from the small caps and how we can take advantage of this unexplored world of the small caps? How and why we can beat mutual funds having highly qualified fund managers? Why one should avoid hot stocks and should invest in less known companies? So now first we will see the simple definition. Small cap, that is defined as the companies having less than 5,000 crore market cap. Mid cap 5,000 to 20,000 crore market cap, and large cap, that is more than 20,000 crore market cap. So now we will see the various examples. Asian Paints, Pidilite, Titan, Eicher Motors. So what are the common things in all these companies? They were small caps 20 years back. They have given around 100 beggars return and that is in 20 years of duration. What is fourth common? They had lost around 30 to 50% share price multiple times during their journey. Let's take example of Eicher Motors. In 2017, it was around 3,200 rupees. In 2020, it was around 1,400 and in 2022 it was around 3,600 rupees. So if fundamentals are intact, stock will definitely recover. Now what is fifth common among all these companies? All companies were more than 15 years old when they were small caps, so you don't need to invest in startups or IPO for multi-bagger return. Invest in the companies having proven long track record. Now we will see other example, that is Yes Bank, Suzlon, Syntax, Vodafone and many more. So for few multi-bagger stocks, there are hundreds of small caps or the mid caps which have disappeared from the market or they have lost around 90% of their value. We have to separate the wheat from the chaff. Now, other example is Reliance, HUL, and L&T, and the Infosys. So these are the large cap stocks. Large cap stocks are more stable companies than the small caps, but their growth rate is also slower than the small caps. Let's take example of Reliance. In 2008, it was around 600 rupees. In 2022, it was around 2,600 rupees. So Reliance has given around 11% CAGR return during this period. Now, if you go for large cap stocks, minimal study is required, but if you buy small cap stocks, very in depth study is required. So, is it fruitful to do such exercise for just 3 to 5% higher return? Let's take one example. We have four options. First option, you invest in the mutual fund. Second option, you invest in large cap stocks, and that portfolio gives around 14% CAGR return. Option C is you invest in good small cap stocks and that gives you 16% CAGR return. And option D is you do in-depth study of small cap stocks and their portfolio gives you 18% CAGR return. Suppose you invest X amount for 20 years. So after 20 years, the mutual fund will make your asset 9.5 times. Large caps will give you 13.5 times return. Small caps with 16% CAGR return will give you 19.5 times return. While the small cap, which you have done it depth study and 18% CAGR return, it will give you 27 times your return. So your asset will be almost double in small cap stocks than in the large cap stocks in the 20 years of duration if you have selected the good stocks. So it is worth to do in-depth study and understand the small cap stocks. Now, why small cap companies have big move and big companies have small move? So let's see. Growth potential. By definition, small companies have operations that are smaller in size and scale. So there is huge opportunity to grow. As a general rule, growth rate tends to slow as business matures and gets bigger. Company having 50 crore annual profit can rapidly double profit than company having 500 crore profit. So stock price will follow the company's profit in long term. So when the profit rises, stock price will follow it. And second point is low institutional holding in the small caps. The small companies are less covered by the institutes and analysts, and therefore there are chances that you will get them undervalued. So these are the two reasons why the small caps have big moves. In certain markets, large cap may perform well, but when you see in long term, say 5 to 10 years, you will get biggest moves in smaller companies. You cannot expect from Reliance, TCS, or Wipro to quadruple your money in just 2 years. If you buy Reliance at the right price, you might triple your money in 6 years, but you are not going to hit the jackpot in just 2 years. For that, you require small cap stocks. Sometimes a series of misfortunes will drag large cap at very low level and it may give huge return once the problems are sorted out. But these are the rare exceptions. As a general rule, staying below the 5,000 crore market cap companies will have more chances of finding multi-bagger small companies. On the other hand, you should not assume you need to dive into the micro caps and buy 25 cents of stocks. Less than 500 crore companies are very risky and due to their corporate governance issue and financial instability. As a general rule, I suggest focusing on the companies having market cap of 1000 crore to 5000 crore. So why most retail investors stay away from the small caps? So there are two risks, that is equity risk. Most large cap stocks are stable companies while many small caps have financial risk, operational risk or information data availability risk. So if your selection of the small cap goes wrong, you may lose 50 to 80% of your capital. And second reason is high volatility. Small cap stocks experience huge volatility swings, especially in the declining market, meaning many investors cannot stomach this kind of uncertainty. Before buying small cap stocks, always remember that they will go more down during the bear phase and they will go more up during the bull phase than that the large cap peers. Let's take example of Netflix. Netflix, which has been multi-bagger 60 baggers returns it has given since 2002. It lost around 25% of its value in a single day, 4 times of its market cap. On its worst day, it fell around 41%, and there was a 4 month stretch where it dropped around 80%. So there is highly volatility in the this type of stocks. Now, how to reduce the risk of small caps? First, you have to do in-depth study. If you invest in Bajaj Finance, Reliance, or TCS without any study, and stock goes down, sooner or later the stock will recover in most of the cases. We cannot expect same thing from the small cap stocks. So one has to do in-depth study and deep analysis before buying small cap stocks. One can reduce the equity risk by studying the company. More you study, better it is. Long term horizon, sticking to valuation criteria, and optimum diversification. All these points we will discuss in other lectures. Now, the long term investment to overcome the volatility. MRF is the best example for explaining the volatility and the recovery of the stock if fundamentals of the companies are intact. MRF was around in 1990, it was around 320 rupees. In 2022, it was around 83,000 rupees. So it has given 19% CAGR return. However, this ride is not so easy as it looks like. The stock has seen the following crashes: Harshad Mehta scam in 1992, the dot-com bubble crash in 2000, the financial crisis of 2008, and coronavirus-led market crash in 2020. When the market crashed in 2001, MRF price crashed to a low of 400 rupees from 2500 rupees. So it is impossible to make money in the stock market without suffering through its ups and downs. The hallmark of the successful long-term investors is ability to ride through the difficult times. Your confidence and conviction in the company will be tested multiple times. So Peter Lynch says everyone has the brain power to make the money. in the stock market, not everyone has stomach to digest it. So if you are susceptible to selling everything in a panic, you ought to avoid stocks and mutual funds together. Now, why mutual fund managers stay away from the small caps? For laymen, it seems surprising that the small caps give such good return and mutual fund managers can easily rule out the risk of small caps. Then why the fund managers stay away from the small caps? The reasons are most of the mutual funds or the institutes do not allow the more than 10% shareholding in any single company. So this will miss the small, fast-growing companies. If large institutes invest even just 1% of their capital in small company, their holding in that company will become more than 10 to 15%. So even though Warren Buffett or the Peter Lynch discover good stock small caps company, they cannot invest as they cannot have sizable gain compared to their capital. Buffett once was asked where individual investors should look for the investments. Buffett replied that he thought small cap stocks were great hunting grounds because large institutions cannot invest here. So second thing is risk of people's money. Mutual fund managers are smarter, but their hands are tied because they are investing people's money who want a return in short time. So if fund does not perform or it does not give good return in short time, redemption pressure built up. So they avoid to do risky bets and invest in large caps or the mid caps. Mutual funds disclose the net asset values of the all schemes on a daily basis. Therefore, each mutual fund gets compared to its peers on a daily basis, despite the mutual funds being the long-term products. Distributors and the advisors are known to ask the questions focusing on the short-term performance more than the long-term. Now, if fund manager risks investors' money to small unknown companies and it does not perform, he is answerable and even he may fire from the job. However, if fund manager invests in TCS and it does not give good return, then none of his was asked why the fund has not performed well. So these are the two reasons. And the third reason is market cap less than 1000 crore. Some funds have rules that they cannot invest below predefined market cap, that is less than 1000 crore market cap, to reduce the risk. So now we will see how the retail investors can beat the mutual fund. Many of us may have one question in our mind how we can beat the mutual funds who have highly qualified professionals. So there are two ways we can beat the mutual funds. The first is concentrated portfolio and second is small cap investing. The primary focus of the mutual fund is to reduce the equity risk by investing in 60 to 100 companies. Such over diversified portfolio gives return around 14 to 12 to 14% CAGR return. So you make concentrated portfolio of around 10 to 20 stocks for beating the index. And second is small cap investing. As we had seen earlier, mutual fund managers work for securing his job rather than beating the index and avoids investment in retail non-small companies. So we see the 50 to 60% of the mutual funds could not beat index in the past 10 years. Now we will see the second point of our this lecture. So invest in the companies that have not caught the fancy of the Wall Street. Peter Lynch says, if I have to avoid one stock, it will be hottest stock in the hottest industry. Hot stock is the stock that is discussed everywhere, including media, TV channels, and newspapers. So everyone wants this hot stock in his or her portfolio. So you will never get them at discount price to its intrinsic value. There is nothing intelligent thing to do in this type of investment. If you will not exit from this hot stock in the right time, you may lose half your capital soon. Peter Lynch favors investing in the companies that nobody cares about and little discussed in the financial community. So invest in a simple companies that appear dull, mundane and out of favor. You will get these companies at discount price. Invest in good stocks with nil or least institutional investment in institutional holding. So if you have chosen good stock before entry of the institutes, share price will get a further boost as Wall Street and institutional investors take notice and enter it later. They will always enter only after a certain market cap, as we have seen in previous slides. So if you find company having no institutional investor, you have found potential winner. But if there is no analyst following the company, you have found double winners. So summaries. The first one, invest in good small cap companies, that is 1000 to 5000 crore market cap. This is the unexplored area as most retail investors and institutional investors stay away from. You will all get them at discount to intrinsic value. And second thing, these stocks have very high growth potential. So invest in small caps. This is the place where you can find 10 beggars, 20 beggars, or more. Second is selection of the good stocks is the key in small cap investment. You can lose 80% of your capital if you have not selected small caps properly. So very in-depth study of the small cap stocks is required before buying them. Third one is don't go for micro cap less than 500 crore market cap. Let these companies grow before investing in them. Fourth one is invest in company that is not much discussed in financial community and having less institutional holding. So if you have invested in these companies, the entry of institutes in future will give the boost to the stock price and you can have your multi-bagger. And the fifth one is long-term horizon. 5 years or 10 years or even more duration of the investment is required to make good return, especially in the small cap stocks to overcome its volatility that is ups and downs. Six, the portfolio of the 10 to 20 stocks that is what you require. For small portfolio, you may require 8 to 10 stocks. For big portfolio, you require 15 to 25 stocks. Over diversification cannot give good return. Let that be seen in mutual fund. Mutual fund having 50 to 60 stocks that hardly beats the index that gives around 12 to 14% CAGR return. So we will discuss this concentrated versus diversified portfolio and its advantages and disadvantages in the other lectures. So explore the unknown and beat the index. This video is only for the educational purpose. Take expert's opinion before investing. Subscribe my channel for the next series of lectures. Thank you very much.